Stocks, bonds, gold, and oil all falling off together. Here to pick up the pieces is Alec Young from S&P Capital IQ. Welcome, Alec, and tell me, did the Fed's words merit this sell-off?
I think they did. I mean, what we've really seen is assets across stocks, bonds, commodities all benefiting dramatically from the Fed's aggressive QE stimulus over the last few years. And so it makes sense that, as the Fed increased their outlook for the economy, investors assumed, well, we must be that much closer to an inevitable tapering of Fed quantitative easing and then eventually tightening of monetary policy. All those negatives are now closer than they were before Bernanke's testimony because he told us that the Fed had upgraded their view of the U.S. economy. So all of these asset classes that have benefited so much from QE are having to be repriced downward to reflect the accelerated timeline for tapering.
And this is just the threat of tapering. What happens when they actually do it? So are we just taking the pain now and things are going to be better later?
Well, it depends on how aggressively they taper and how much they wind up having to raise interest rates down the road. All that's very unclear at this point. But clearly, the markets are well on their way to pricing in at least the initial tapering. So when that happens, it should definitely be in the stock market. It shouldn't cause a lot of volatility. And from there, it'll be about, well, how quickly do they taper down their bond buying? How quickly do they subsequently start to raise interest rates? What's the economic outlook look like? Obviously, the economy needs to continue to gradually improve for any of this to even be on the table. If the rise in interest rates that we're seeing right now slows the economy too much, the irony may be that the very tapering that investors are pricing in doesn't happen because investors have driven up bond yields so high that it chokes off the recovery. So there's definitely a lot of uncertainty out there, but this issue is not going away. It's sort of an open-ended risk because, as you said, they haven't even started to taper yet, and interest rates, while they're up, are still very low historically. So I think this whole Fed watch situation is going to be with us for many months.
Well, right now, as I said, everything is going down together. Everything is correlated out there. Is there anywhere to hide other than under your mattress?
I think right now the expression cash is king comes to mind. That's really the only shelter in the current environment. People that were wise enough to keep some dry powder when everything was going so great, now have the opportunity to maybe put money to work at more attractive levels. But given that higher rates are what's sparking this sell-off, you can't even turn to things like treasuries for safety the way that you normally would.
And then finally, is the U.S. still the best house in a bad neighborhood because things seem to be worse in the emerging markets?
Absolutely. The U.S. is still the best house on the bad block. Emerging markets have benefited dramatically through carry trades from the very low interest rates in the U.S., which prompted a lot of investors to borrow in dollars in search of higher yields. And a lot of that money wound up in Brazil and Russia and Turkey. And now with markets worrying that we may have seen a peak in stimulus from the Fed, people are unwinding a lot of these carry trades. So the volatility that we're seeing here in the U.S. today is really just a small fraction of the losses that we've seen in some of the international markets, especially emerging markets recently.
All right, thanks a lot, Alec.
Thank you.